Thank you, João. Pleasure to be here. I want to start with a story. It happened almost 60 years ago, and it still gets talked about today. And you may or may not have heard of it. In 1953, President Eisenhower appointed a man named Charles Wilson to be his Secretary of Defense. And Wilson was then president of General Motors. And he decided to retain his General Motors stocks. So in his confirmation hearings, someone asked him, Mr. Wilson, are you in a position to take a decision that would be bad for General Motors? And he gave an answer that became legendary. He said he wasn't that concerned because what's good for General Motors is good for America. Now, I see a parallel between the auto industry back then and the banking industry since the 80s. I think everyone has everyone has come to believe that what's good for the banking industry is good for America. However, I think that's changing. And in part, this is changing as a political reaction to the 2008 debacle. Banks indeed screwed up and people are still upset. But there's a lot more. Banks do three things. They lend, thus they are engaged in intermediation. They make payment, we call that plumbing, and they create money. And so their power and prestige stems from the fact that they do three things that are so important. They intermediate, they do the plumbing, and they create money. But technology and politics and many other things are changing that. And the way to make sense of that is to realize that these three functions are being disentangled from one another. So commercial banks will not disappear, they'll not become irrelevant, but their heydays are gone. And importantly, for the present discussion, this is good news for Fintechs. To understand what's going on with banks, we would have to tell three interconnected stories. I tell them to my students sometimes, but here I don't have enough time. We would have to tell, it's not even a story, it's a history. We would have to tell the history of the evolution of lending, then the history of the evolution of payments. And by the way, Amy has just had a nice framing, a nice insight for that when he said that the evolution of payments is in the headwinds of changes in e-commerce. And that's an interesting point. But in any case, the third story, which is the one I'll focus on, is the history of the evolution of money creation. In all of these stories, the role of traditional banks is decreasing. So let me try to summarize the most important within those three stories, which is the history of the digitalization of money. And it clearly explains, I hope, why the role of banks in money creation is going down. And again, why this is good news for fintechs. As I see it, there are four stages in the digitalization of money. The first is the era of digital account balances, digital bank deposits. With computers and the internet, almost all of the money becomes digital. And what is the nature of this money in digital form? Most of it is private money. But private money, of what kind exactly? Private money in terms of bank deposits, that is current account balances. We forget that bank deposits are money, but they're not the same thing. And the money that is issued by the banks when they make loans performs all the classic functions of currency. It's a value of storage, so you can save in your bank account. It's a unit of account because it's denominated in dollars, and so it allows you to establish the relative values of things. And it's a means of payment, very importantly. Now, bank deposits, they're money, but they don't have it doesn't have legal tender. So theoretically, someone could reject payment with a current account balance and request, say, physical cash instead. But for obvious reasons, nobody does that. And so in practice, digital bank account balances, that is digital bank deposits, are just as good as money. So let's not get lost then. The first stage in the history of digitalization of money is this period where almost all of the money, so to speak, feels digital and is created by banks. And at the same time, physical cash, which is the money created by the government, is only used for small purchases, if at all, and very importantly, for illegal activities. What's the second stage? The second stage is an intermediary stage between the digital bank deposits and central bank digital currencies. It's exactly where we're now. It's a time of transition. And in this era, there are a few things happening. The first is the resurgence of other types of private money beyond bank account money. And many of these new types of money are created because of a new technology, cryptography. And their moneyness, the moneyness of this new assets, they can come from different things. So if you take Bitcoin, for example, is the cryptographic security associated with a stock limit. Then if you take, let's say, digital gold, it's linking with another asset. There's the stable coins, which is the convertibility into bank money, and so on and so forth. Now, these types of private money can be very speculative, but increasingly they're becoming central to the payment systems. And so Sarah was just now talking about, sorry, you were talking about, you were saying the valuation of, it just escapes me, the valuation of
Stripe.
Sorry?
Stripe.
Yeah, is higher than the valuation of the stocks from the banks, right?
Okay, so, PayPal. PayPal is
so much.
larger than Wells Fargo City.
Yeah, so PayPal is the example I have in mind. It just escaped me. And so other types of electronic money are, say, WeChat and Alipay in China and M-Pesa in places in Africa and so on. But the government is sometimes using electronic money to improve payments as well. And there are many examples. So there's Pix in Brazil. If you have any doubts about it, you should ask João, right? But there are many other countries doing similar things, the UK, Australia, Nigeria, and many others. And the United States is doing that as well. And it's going to be called FedNow, and it's created to support real-time digital payments nationally. But it's still not the new stage, which is the creation of CBDCs, central bank digital currencies. The European Central Bank says it's going to launch CBDCs in 2025. China is already doling out some CBDCs through lotteries just to see how it goes. The US is, for understandable reasons, taking its time and hasn't announced any plans for creating CBDCs, but it's going to come. So what's a CBDC? Well, it's not simply electronic money. It has two very important traits, or maybe we should say three. One is it's issued by the government, but the second is it's not convertible into anything else like, say, stable coins. And finally, and this is the crucial characteristic of a CBDC, it's digital fiat currency. It's the real deal. It's cash. It's an obligation of the central bank, and therefore it's M0, just like bank reserves, just like cash. But very importantly, maybe this is the fourth characteristic, right? Since it's the real deal, since it's like cash, Then it's legal tender. So it's exactly the same as paper money, but it's in digital form. Are we there already, right? As I said, mostly we're not, but there's one exception, and that's the Bahamas. The Central Bank of the Bahamas has issued a CBDC, and that's a huge change from the perspective of money creation, because the issuance of CBDCs prevents banks from creating new money. In the Bahamas, it works like this. For every token the commercial bank issues, they call it the cent dollar, the commercial bank must have $1 Bahamian deposited with the Central Bank of the Bahamas. So in other words, it's the end of fractionary reserves. It's the end of private bank money creation. It means private banks will do payments and lending, but will create less money. In simple words, what's happening here is a devolution of monetary powers to the government. And this is a very dangerous business, and I've written a short paper about that precisely to highlight the risks. But that's not yet the end of the story or the history, because there's a fourth and last stage. As soon as the CBDCs, the central bank digital currencies, are out, countries will start playing with smart CBDCs, programmable CBDCs. And then central bank currencies acquire new functions. Smart CBDCs do more than storing value and serving as unit of account and serving as means of payment. They become programmable networks for verifiable commerce. You go to the bakery and you pay with a CBDC, the sales contract is automatically closed. But that's very tricky, because governments can do a lot of things with smart CBDCs. They can monitor people, and so that's why so many folks are so worried about privacy with CBDCs. But they can do other tricks. For example, they can determine that the CBDC will expire after, let's say, 1 year or 2 years if they want to make people spend more money. Or they can create, they can sort of tax your CBDC or create a negative interest rate and so on and so forth. So let me conclude. Let me say this. You open the newspaper and everybody's talking about Bitcoin and Facebook's Libra or Diem now and ICOs, etc. And this is all a tale of private money challenging public money. But CBDCs will greatly empower governments. And that reminds us that the future might bring more, not less, government and public money. But here's the deal for those interested in fintech. Whether new money will be public through CBDCs or private through Bitcoin or what have you, it's bad news for the incumbents, the commercial banks, and it's good news for the entrants, the fintechs. Thank you.